So this just happened. Bill Ackman, yeah, the same guy who's been quietly betting against broken systems for years, is about to go live with a plan to free Fannie Mae and Freddie Mac after 17 years in government lockdown. And he's unveiling it tomorrow morning as I'm recording this. There's a good chance it's already happened by the time you're seeing this. And if you own a home, a retirement account, or even a few bucks sitting in the savings, this is about to hit you right in the numbers, because these two companies touch almost half the mortgages in America. And if it feels like the rules keep shifting and it's always your savings that gets squeezed, you're not imagining a thing. And the part that should bother you is how close this feels to the same playbook we saw right before 2008. Insiders arguing over the rules while regular people absorb the fallout. Here's what you want to keep in mind. Ackman owns more than 200 million shares. The stock jumped almost 10 times in a year. They're calling this reform, but the timing is way too convenient. They're saying privatized while promising the same old government guarantees. Every time they blend private profit with public risk, you know exactly who ends up paying. Let me make this simple. This is like two power players fighting over the bridge you drive over every day. You never think about the bridge. You only feel it when they change the tolls. Well, Fannie and Freddie are those tolls. And now they're fighting over who controls the price of your mortgage. And here's what this unlocks or threatens for you. Start watching the gap between the 10-year treasury and the 30-year mortgage, not just the headline rate. That's where this hits you first, the spread. If it widens, your next loan or refi gets more expensive fast. And if you're already thinking about refinancing, this kind of noise can cost you real money, but you can use the same playbook they do, quietly, legally, and it works to where it doesn't cost you, but it pays you. So stick with safe, fixed rates. Use creative terms when sellers are stressed. Don't be the test subject for whatever shiny new mortgage product they trot out next, because this isn't loud or public. It's a quiet plan. And quiet plans are usually the ones that hit homeowners the hardest. And here's why this matters. If this plan pops, the hedge funds win big. If it blows up, taxpayers, meaning you, get the bill again. Small lenders get squeezed. First-time buyers get pushed even further out. And wider spreads mean you're staring at a higher monthly payment, even if the Fed doesn't move a thing. Now here's the quiet part no one's saying out loud. This isn't random. This is coordinated. The same institutions that helped build the mess are now calling themselves the fix. They'll say this is for you, but the first people to cash out are the ones who bought these shares for $2 or $3 back in 2013. And a whole lot of them are very, very connected. That's the clear enemy here. Insiders who privatize gains and socialize losses. Here's what the experts are fighting about. One camp says a clean exit could modernize the whole system if they keep the rules tight. Another says Fannie and Freddie should have been shut down years ago. And the cautious group says push this too fast and regular people get crushed with higher mortgage costs. The split is wide and the stakes are yours. Here's what most people are missing, and the pattern's clear. Every few years they float a reform. They tweak a few rules, they pretend something changed, and the system drifts right back toward more risk, but always with the government safety net underneath. It's slow, it's quiet, and it drains regular people while the insiders get cleaner odds. As always though, there are two sides to the story. Side A says privatization brings discipline and lower costs. Side B says it hands billions to a tiny circle and leaves taxpayers with the downside. So here's what the smartest guy in the room isn't noticing though. This isn't about public versus private. This is about who controls the guarantee behind your mortgage. That's the entire power move. And here's what everyone wants answered right now. Will this make your rate go up? Well, if spreads widen, yeah. Will your next refi cost more? Well, if the market senses more risk, yes. Could this lead to another bailout? Well, we don't have clean data yet, but the structure sure rhymes with 2008. And is the 30-year fixed in danger? Well, it's not dead, but it may get a lot less friendly. And who's already positioning? Well, watch the hedge funds adding shares before the announcement. And here's what we still need to know and we need to see before anyone can really call this safe, before we really even know what's going to happen. The questions that you want to ask are, what happens to the government's massive preferred stake? How strong is the new guarantee and who eats losses in a crisis? How do they keep spreads tight when shareholders want bigger returns? And will lenders tighten credit on regular people to protect themselves? And what's the real timeline, not the political one? If you've got answers to any of those questions, drop them down below. I want to know. But a real clue as to where we're headed is, has this happened before? Well, yeah, the savings and loan crisis, the run-up to 2008. Every time they mix private profits with public protection, regular families are the ones who bleed. For the next 2 or 3 years, expect a slow grind, not a clean break. More noise, more policy swings, and a whole lot of confusion for regular buyers. The lesson's the same as always. Carry debt that still works if the spreads widen. Anything better, it's upside. Quick translation for you if you're a landlord, don't depend on one funding source. Make sure at least one property in your portfolio runs on terms that you control, not whatever the system decides this week. And that's the real takeaway here. The rules can shift overnight. They don't warn you. And the people with fast access to cash, they're the ones who walk away with the deals while everyone else is still waiting on a phone call. And that's why I pulled this next one out for you to watch next, because it shows exactly how regular investors lose life-changing deals just because their money moves too slow, and how the smart ones stay ready before the next window opens. You'll see why the system favors the fast. You'll see why money at the ready beats any interest rate. And you'll see the simple defenses regular people are using so they don't get boxed out.